Have you ever wondered if you're too old to take out a whole life insurance policy, specifically focusing on the cash value? Chances are likely that you are not too old. I remember a number of years ago, our office received a call, and it was from an older gentleman. He called himself a doctor, and I take the call. Sure, I'd love to talk to him. And he starts asking me all these questions about high cash value life insurance. He's asking about how to design a policy, different rider terms. I'm like, okay, is this guy someone who calls himself a doctor, but he's really something else? Because we run into that all the time at our company. Turns out he's not. He is a doctor. He's a tooth doctor. That's not a good term. He's an endodontist. I really enjoy working with him. When I connected with him, he was 74 years old. Very sharp guy, asking me all these questions that, frankly, insurance agents usually ask. A lot of times they'll call our office pretending to be someone else and trying to get information. But talking to him, he gets it. And he said, okay, I like these options I'm seeing on your website and all. I'd like to meet. He had been working with other individuals. He was interested in high cash value life insurance, and he wanted to beef up the cash value. He also coaches other doctors, other people in his profession on how to increase their revenue as a practice, and then also what to do with their money once they pay off their debt. So I connect with him, and I remember this, 10 minutes into the meeting, which this meeting, he's 74, and he goes, hey, let me show you something, Steve. And I give him control of the screen, and he just starts whipping through it. He's 74 years old. Like my dad, he's almost 60 and he can't do that with a computer. Nothing against my dad, you have to have used a computer several times to know it in and out. This guy's 74, I'm like, how? What? This is like what I do when I go through it. I was impressed. But 10 minutes into that call, show him different options. He was looking at a policy with $200,000 per year going in, looks at the options, he goes, oh, all right, I'll take that one. I was kind of thrown off. We're used to people moving fast, but just like that, yeah, I'll take that one. That looks pretty good. I'm like, all right. He goes, you do that, don't you? I'm like, yeah, we do that. No problem. So in working with him, he actually ended up paying it a bit more than that, but he was interested in a personal policy of the amount I mentioned, and then also for family members. So he's in his 70s. He's interested in the cash value, but he's also interested in the death benefit. He's looking at that more now, just from an estate planning standpoint, but building generational wealth for his family, for his kids and grandkids, which he has established policies. He's cash flowing them close to $500,000 per year. So from the family office concept and creating generational wealth, when I say family office concept, not so much a board of advisors. He does have advisors, but more so establishing that family office concept, leaving wealth from one generation to another, having advisors, people in his family and others to ensure that money, when it's left to the next generation, it's not blown on a Ferrari or something like that. Tax-free death benefit comes in, can feed the policies further, can continue to repeat the process. He's got generational wealth going on. He discovered it, he had cash on hand, and he moved quick. So he's 74. You could say he's lost a lot of time, but he's got a ton of capital that he can infuse the policies with, not only for himself, but other family members as well. And he uses them heavily for loans and such, and he puts them to good use. Now, the question I would have, if a 74 or 75-year-old individual took out a policy, that's the example we're going to look at here, my question would be, well, how's it designed? Because if a policy is not designed properly, especially when you're older, it can hurt. And what do the guaranteed values look like? Now, we're going to look at these values. The policy we're going to look at here is very, very similar to what he did, same company and everything. We're going to look at $250 per year. He pays in a touch less than that. I just wanted a round number. We're going to have an approximate $25,000 base premium, a little bit less actually, everything else into PUAs. Let's take a look. First, we'll look at the guarantees. Now, what I want to touch on here is when looking at a cash value life insurance policy, it is beneficial to look at the guarantees. And often it's neglected, or one hears, don't worry about that. It's a worst case scenario. It's never happened. Companies have always delivered greater cash values and death benefits than that. and it's true. However, it is beneficial to look at. And what we see sometimes is fear around showing numbers that don't look as attractive, like this on a 75-year-old individual. When's his break-even point? Based on the guarantees, he pays in what? 250 grand for 6 years up until age 80, nothing thereafter. By year 6, he's paid in 1.5. He has 1.34 million. Death benefits, 2.18 million. Where we came up with that, by the way, because it's kind of an oddball number, is that is the minimum death benefit at his age to obtain a MEC limit of 250K. So that's where we came up with that oddball number in this scenario. But aside from that, 88 is his break-even point. It's a long time to get your money back. Granted, it's based on the guarantees, but my point here, what I want to emphasize is we don't want to just brush over the guarantees. We're not explaining it because we're afraid of losing a sale or the person might question it and like, it's the uncomfortable piece I don't want to talk about. I used to do this, and it's not good because imagine if you move forward with a policy, the guarantees were not touched on, and then someone else, perhaps a competitor, comes to you, the consumer, and says, hey, here are the guarantees. Did you know about this? That guaranteed, like, you might not have more money than what you paid into your 88. Like, you might not even be alive then. Competitor might do that. And that makes you as the agent, or me as the agent, look bad. So my point here is you don't have to always go into every horrible detail, but be transparent. Show the good, show the bad, just like what you would want to see if you're looking at different options and considering different options. So based on the guarantees, there we go. Non-guarantees, which is what the policy's been doing, and you can expect that, the major mutual companies, sometimes a little more conservative, but we look at different options, different assumptions, I should say. 250 per year. Year 5, 1.25 in, 1.25 and another $9,000 in cash value. Breaking even year 5. Whole life insurance product. Same death benefit, because that gives us the MEC limit. It's the exact same product, actually. Nothing in after year 6. Now, the reality of this is he's probably going to still continue to pump money in because the product's working out. It's doing what he wants it to do. Cash value continues to grow. Nice. If we look at age, I don't want to go to 90. Let's look at 85. 1.9 million. So he's paid in 1.5. He has 1.9 in cash value. The death benefit is 2.35. Now you could say, hey, I paid in 1.5 million, and if I die at 85, my beneficiaries get $2,352,000. That's an $850,000 gain. It's not that much. However, that is tax-free. Remember going over that with my dad, there were different figures, but he said, hey, I paid in this much and here's my death benefit. Like, yeah, that's it. We're looking at the guarantees or a conservative assumption, but I did add, that is a tax-free death benefit though to the beneficiaries. And my dad's remark was, that's heavy. Because he understands the taxable impact there and a tax-free check, especially if you're a high income earner, or even if you're not, like a tax-free check goes a long way. Focusing on the death benefit, because my father was more attracted to the death benefit and the cash value. I mean, when we looked at the IRR in this case, it'll do between 3 and 4%. Pops is the same thing, a little bit lower, actually with the health rating he had, but still, he looked at it and said, hey, if it's 3 to 3.5%, like I was looking at other investments, other places to put my money. I know the life insurance policy, it's not an investment, but it's tax-free. Everything else, if I do 5 or 6%, is taxable. And this one I've got to think about it. Okay, sounds great. I can put money here and then leverage it as well if I ever want to borrow against it or get a collateral loan against it. Anyway, original question, do we ever feel that we're too old to obtain a policy? And the answer really is no. I'll add this. For a male, when you hit the age 78, 79, or 80 and above, it's tough, unless it's a joint survivorship policy. But it's difficult to get a policy. If you're a female, Quick tip here, or nice little piece of knowledge, is females are priced 7 years younger than males. So what that means is if I am a 80-year-old male, let me rephrase, if I'm a 80-year-old female, from an insurance pricing standpoint, that is an equivalent to a 73-year-old male. We just looked at a 75-year-old male. The reason why is females live longer than us guys, so they have an advantage there. From a cash value perspective, that results in a lower insurance expense, more cash value, more death benefit long-term too. So for females, you can do it at age 80. Depends on the product because different companies have limitations at age 80. But am I too old? No. If I'm in my 80s, I might have to look at a survivorship policy. There is a cutoff, but a lot of times people feel they're too old when they're in their 50s, which is not the case at all. Anyway, hope you enjoyed this one. I love talking about this stuff and I can go all day long. But if you have any questions, please reach out anytime. We'd love to talk to you. Our entire company likes talking to everyone. If you enjoyed, please hit the like button, subscribe for more, and I hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.